Welcome to China Perspectives, a podcast on economic and credit developments in China, featuring experts from within and outside of Fitch Ratings. My name is Yan Wang, head of North Asia Industrials, Property, Consumer, and Utilities at Fitch Ratings. In today's podcast, I'm joined by my colleague Penny Chen, Senior Director of Fitch Ratings, to discuss the latest development in China's power sector and key credit themes for Chinese power generation companies. Penny joined Fitch in 2015 and she is based in Shanghai. She is head of the Greater China Utilities team. Penny, thank you so much for joining the podcast.
Thanks, Ying, for having me here.
So, to start our discussion today, what are some of the key changes taking place in China's power sector with meaningful implications for power generators, which you and your team are watching out closely?
Sure. The most noticeable change in China's power sector is the rapid growth of renewable power, particularly wind and solar power. By end of first quarter this year, the combined capacity of wind and solar have reached around 1.5 terawatt, beating thermal power and becoming China's largest power source. And with that, the whole power system needs to make changes to handle the intermittent nature of renewables. Firstly, the role of thermal power is evolving from providing baseload to becoming load-following units. Thermal plants now reduce their output during periods of high renewable generation, and they will ramp up when renewables can't meet the power demand. And beyond peak shaving, those power plants, they are also offering other ancillary services to maintain the system stability. Secondly, the pricing mechanism for thermal and renewables are also changing. Previously, grid companies purchased or generated renewable power at fixed price for the project's lifetime. However, with renewable capacity growing faster than both overall power demand and the grid infrastructure, currently we think that grid companies will no longer be able to buy all the renewable power generated, which leads to an increase in market trading. China aims to have all the renewable power traded in the market by end of 2030, and to facilitate this transition, a new mechanism tariff started in June 2025. Unlike the previous off-taking, it is determined through a competitive bidding process, which will generate a tariff which is lower and less stable than the fixed off-take tariff, but still it offers greater predictability than pure market trades, as the awarded tariff remains valid for several years post-bidding. So to sum up, I think how we generate, distribute, and price electricity has changed quite a lot, and this has an implication on the overall power sector.
Okay, thank you, Penny. So I'd like to follow up on this given the changes that you just mentioned. What are the key credit themes for Chinese power generation companies in the near to medium term?
Yeah, as I've just mentioned, industry is changing, so our rated power generation companies. So we are also seeing a clear shift towards renewables among our rated major China power generation companies. By 2024, renewables has made up nearly half of the capacity for China Huanen and China Huadian, and even higher at 65% for SPIC. Because renewable typically have higher EBITDA margin than thermal power, they now contribute most of these companies' earnings. Compared to thermal power, renewable power has a more stable business profile. They are not affected by fuel price change, and many projects still enjoy fixed tariffs. Of course, renewables have higher resource risks, but this is mitigated by the large diversification of our rated gencos. However, looking ahead, the sector faces new market risks, as I've just mentioned. The tariffs will be lower, and there will be increased curtailment risk, as grid development did not catch up with the renewable installation. But on the other hand, the business profile for thermal power is also improving. They are moving from baseload to more of a backup role. A new capacity tariff and the ancillary service income were introduced to offset lower utilization in this transition. We expect these payments to make up a bigger share of thermal power's profit, making their earnings more stable. Their key value going forward will be helping to keep the overall stability of the power system. So, going into the future, we expect volume and fuel cost will have a much lower impact on their earnings. And another impact we've seen is on the CapEx side. All these investments in renewables has pushed up CapEx over the past few years. But with rising market risk, we expect our rated power generation companies will likely become more selective in future new projects. As a result, we expect CapEx to peak around 2025. So, in summary, we believe this transition is broadly positive for the Power Genco's business profiles. Leverage has increased, but we expect that to ease as CapEx drops and new clean energy capacity boost earnings in the future.
That's a very clear summary, and that leads to my next question. What is Fitch's credit outlook on China's power generation sector in the remainder of 2025 and possibly into 2026?
Okay. Our outlook for China's power sector is stable for 2025 and likely to be stable as well in 2026. There are a few changes worth noting for 2025. First, power demand isn't growing as fast as before. We now forecast a low single digit power demand growth. That is mostly because of a warm winter, ongoing weakness in the property market, and uncertainties around export related manufacturing. But as I mentioned earlier, lower volume don't have as much an impact on power generators as they used to. Instead, the combination of surging renewables and the slower demand has pushed down the need for thermal coal. And at the same time, domestic coal production actually went up a lot. So this has caused coal price to fall substantially. Spot price now is already more than 20% lower than last year. Since most thermal power tariffs are fixed in annual contracts at the start of the year, this could boost margins for thermal power companies. And we already talked about a new pricing mechanism for renewables that will be implemented from June this year. This has prompted a rush to complete renewable projects by end of May so that they can still qualify for higher tariffs. After that, we expect to see a slowdown in new capacity additions as companies will be more cautious with investments given the prospects of lower tariff and the higher pricing uncertainty. So while CapEx will probably remain high in 2025, this should be balanced by higher EBITDA thanks to the new capacity and a better margin. In 2026, things will revert a bit. Tariffs will decline to reflect lower coal price in this year, but CapEx will decline as well. So overall, we expect a stable outlook for the sector both in this year and the next.
Okay, so that's a great summary, which leads to my last question for the day. What do you anticipate as the future direction of China's power sector reform, with a goal to shift towards a more modern power system? In particular, what do you see as potential impact for Fitch's rated state-owned power companies along the way?
So, from a long term perspective, China has actually already laid out a plan to build a modern power system that will guide the industry all the way through to 2060. The aim of this plan is to make the system much cleaner, safer, more efficient, flexible, and intelligent. The vision is that electricity, especially green electricity, will make much a bigger share of China's overall energy mix in the future. A key challenge throughout this transition will be making sure energy remains both secure and affordable as the country moves towards greener sources. So, this modern power system is about better coordination between generation, companies, the grid, power storage, and end users to achieve the ultimate goal of providing a secure and affordable clean energy to the entire society. This also represents a big change in how power generators operate in China. In the past, the grid would allocate generation hours to plants based on their location and pay a fixed tariff. But going forward, performance will be much more depend on factors like cost efficiency, generation flexibility, risk management in the power market, relationships with large customers, and their carbon intensity. This new environment will definitely be more challenging than the previous one, and there surely will be ups and downs along the way. But we believe from a long term perspective, it generally favors our rated state owned power generation companies, who are the market leaders both in regional markets or in the country basis. We believe smaller players will be gradually squeezed out and the market will be more rational.
So I suppose based on what you just said, China's power industry is likely to consolidate in the future. Now we're coming to the end of our podcast. Thank you very much, Penny, for your great insight. You have been listening to Fitch Ratings China Perspectives podcast. To learn more about our ratings and research on China, visit us at fitchratings.com. Please subscribe to iTunes, Spotify, or wherever you get your podcast. Take care until next time.